Hey, what's up, family? Welcome to another Food and Finance Fridays on Lives Legacy. So, do you know how much life insurance you need? How do you know? Why do you, if you have life insurance, how do you know? How do you get how much you have? Usually, when I ask people that question, the answer is that's what the agent sold to me. Okay. Now, there's about 52% of adult Americans that have life insurance. Okay, so that means there's 48% that don't have any at all. Out of the 52% that do have life insurance, a lot of them, about half of those, don't have enough. All right. Sometimes people have too much. Can you have too much? You go look at some different situations and see, you know, who has too much, who doesn't have enough. All right, not specifically, but hypothetically, you can fit yourself into these situations. All right, but before I get into all of that, we're here. I'm here in Northeast Ohio. It's January 16th. Happy heavenly birthday to my father. All right. Um, but it's cold. It's cold here. So a lot of times when it's cold, get some good old comfort soup. All right. My wife made this vegetable soup, and it has tons of vegetables in it. It has corn, carrots, celery, zucchini. I think she put some chickpeas in here. I like to say garbanzo beans. That's another name for it. I just like the way it sounds. Then she also put some wild rice. But then she made this cashew sauce here. All right, so check it out. Mm. That's some good stuff. Yeah. So, man, there's just a little bit of a kick to it. I don't know what type of season she put in there, but there's she got it from a recipe. I'm gonna put the link recipe on YouTube. I'm gonna put that link below. But she also made some homemade tortilla chips. Just put some tortillas in the air fryer. Like, mm. That's good. It's like sweet and spicy. Very good. Very good. Okay, so how do you figure out though how much life insurance you need? Okay, so got my board here. Okay, so there are different ways to figure out. One of the main methods I like to use is called the dime method. Okay, I gotta get a new board because my girl stickers are messing up my E. But okay, excuse me. So what does dime stand for? All right. Pardon me. Okay, so the D stands for two things. One, death, all right, as well as debt. Okay. And then the I stands for income. M is mortgage. And E also stands for two things. Education and estate. That's none of us. Let's see if we can make that a little better. Okay. So we got D for death and debt, I for income, M for mortgage, E for education and estate. All right. So regarding the death, okay. So the average funeral is between 10 and 20,000. Okay, $10,000 to $20,000. So go put that up there, and we pretty much we're gonna use the 20,000 to calculate. And so regarding debt, when we factor in debt, consumer debt, I don't want to put student loans in here because student loans historically they pretty much they die when you die. So, but let's look at in America the average credit card debt is about 15,000. All right. So let's say you have 15,000 before I even write that. Let's say you have 15,000 in credit cards debts. Let's say you have a $10,000 personal loan, but then let's say you also have an auto loan. Let's say you owe. Let's go with another 10,000 on that, right? All right. So that would be 35,000. All right. Now, so you have income, and let's say you have family. All right. So let's say you have an income of $75,000 a year. All right. So you're married. You have two children. Your youngest child is 4 years old. So if your youngest child is 4 years old, pretty much going to need about 20 years of income to replace if you died. Let's say you died today. Okay. If you died today, you need about 20 years of income to replace. So, yeah, 75,000 times 20 years, that'll give you 1.5 million. All right, put some dollar signs up here. All right. Actually, I should have been doing the amount of money in green. Because money is green, right? Okay, I'm not going to do it all. All right, let's say your mortgage, let's say you have a $250,000 mortgage, right? Put that up there, that's what you owe on it. And then education. So I said you had two children, right? And so right now, the average state college is about $25,000 a year. You got a 4-year degree, and you multiply that by two, that'll give you 200,000, right? In your state, we have a state down there. We're not gonna put a number right now, but that excuse me, that factors in about like estate taxes and different things, like stuff you have to settle your estate, okay? But not gonna put a figure on that right now. So when you add all of this up, it comes to about 1.9 million, okay? 1.95, 1.96 was because of the, yeah. So we got that. Grand total of 1. It's a lot on there, a lot to see. I'm gonna put this over here. So it'll be a little easier for everybody to see. All right. See it okay? 1.96 million. Okay. So, in this circumstance, this person, I don't know where that top fell, this person would need $1.96 million of life insurance if they died today. Okay, with having the debt, and they have a spouse they're leaving behind, and two children, the youngest of whom is 4 years old. Okay, so needed education and everything. And now, I understand that not everybody needs to go to college, but you want to have that option. Okay, so that may seem like a lot of insurance. Okay, and let's say this person is 35 years old, right? 35 years old, married, making $75,000 a year. All right, so how does one afford 1.96 million dollars of life insurance? Well, there's some different ways. Okay, now for this person to get $1.96 million of permanent life insurance, that would be a pretty hefty, a pretty hefty premium, that they be dealing with. Yeah, that might be a little hard for someone making $75,000 to afford, of permanent life insurance. Okay, but term life insurance would be a lot less expensive. Only thing about that is, one, it's a term, so it's going in at a certain. It's going in at the end of the term, right? So if they have this mortgage of $250,000, one thing about that is that it is, as you pay it, that's going to decrease. So at day one, they have $250,000 of mortgage right here. I don't know if okay. I hope y'all can see that. Maybe I should have just done it all in blue, but I thought the green, because it's money. All right. Anyhow, so you have $250,000, but it's going to continue to decrease as you pay it off. So one thing you could do, you could get a 30-year term. You get a 30-year term that, in 30 years, you should have paid off this mortgage. But if you should die within this time, it'll help to pay that off. Now, I'm not saying that you just get a $250,000 term, but what you can do is you can get, let's say, a person making $75,000 a year get $250,000 of permanent insurance, right? And no, it's not necessarily. We're gonna look at some things. It's not necessarily what I'm going to do is it going to add up completely to 1.96, but they could get 500,000 of term insurance. That's $750,000 of total insurance. Okay, so why not 1.96 total? So why can't you get like 1.7 of term insurance? That may not be necessary. And one of the reasons is because there's a certain thing called increasing death benefit. Okay, so in the last video I did, I talked about the two different types of life insurance, the basic types. There's the term, which we talk about here. It's going to end at a certain term, okay? 5, 10, 20, 25, 30. In this example, it's 30, or 40-year term, right, with some companies. Well, we're going to use the blend here. So you have the this $500,000 term benefit, term life insurance, and $250,000 permanent insurance. I talked about that increasing death benefit, and I talked about how permanent insurance has cash value. Now, if this is an IUL, we talked about how it uses an index to mirror the growth in the market, right? And as it grows, as the market grows, you get growth in your policy, but it has that floor so that you don't lose money because of a down market. All right. So the beautiful thing is that as the cash value increases, so does the death benefit. Hence the increasing death benefit. So that can help to make up some of what's missing here, because like I said, you only have the $750,000 because you have the $250,000 of permanent insurance, $500,000 of term insurance. Now let's say as a 35-year-old, has $250,000 death benefit, pretty healthy. Might have a $250 premium. Let's say he has a $250 premium. This person has been pretty good with his money and his budget well, although it has the different debts that I just erased, the different expenses. He still has a positive margin. And so what he's going to do in this scenario is he's going to do what's called overfund the policy. Okay? So now at a $250 premium, now that is, once again, that's not the cost of insurance. All right, that $250. Part of it is going to the cost of insurance for the death benefit. The other part is going into for the cash value, and that's building. But this person really wants to overfund the policy, really wants to get it working. So instead of the $250 that the insurance company is saying you need to pay this, to grow your money and to have the death benefit, this person decides he's going to double that. It paid $500, paying premium of $500. So it's overfunding it. Now here's the beautiful thing that's going to happen. Yes, the cash value is going to grow faster, and even if it's just doing, the market is doing bare minimum, it's going to grow some, right? Even if it's getting zero, there's going to be some growth. But the market historically has never had 10 years of zero or even losing, but in the index it's going to be zero because that's going to be the floor. And most index index life insurance policies, the floor is zero. Some have point 0.75, some have 1%. So even when the market is going down, in this policy, still getting at least 1%. You know, it's not a great growth, but everyone else is losing money unless they use some other strategies. And I'm not getting into that. But folks are, if they're using the traditional buy and hold where they're riding, and just investing, then everyone else is losing money. But if you have this policy, you get at least 1%. If the floor is 1%. If the floor is zero, you're not losing money. Okay? So it's growing, but when the market goes up, that $500 is working even harder for you. So then you're end up going to have a much higher death benefit as the years go by. So that's just one of the ways. Just one of the ways that it can help to make up for not having to get that whole $1.96 million of life insurance. Okay, and this you're using a blend to have even to get to 750, right? So you're using the blend of permanent insurance, 250, and 500 of the term insurance. And as your as your death benefit is increasing in that permanent insurance, because you overfunding it and the cash value that you're putting into, that you're earning in it, is going to end up being over a total of $1 million death benefit in, let's say, 10 to 20 years. All right? But this was a 30-year term benefit. So, there are different strategies that you can use. Now, I said sometimes people can have not enough. Sometimes people have too much. Now, this is an example of a person who has, they're married, they have kids, they have a mortgage, they have debt, and they have, you would say, like I said, they have kids, so then they have to think about providing for them. They have to think about, they have to think about education, providing for that. But what if you're a single person? Or what if you're married and you just don't have any kids, you don't have any debt, don't have a mortgage? All right, you won't necessarily need all of that. All right, the team that I work with, we believe that every adult needs at least $250,000 of life insurance. Once again, you can make that up in different ways. You can have a term policy that is what's called convertible, that can convert into a permanent policy later, maybe when you're ready for it. That way you can get that amount, right, that 250,000, and then you can later turn into a permanent policy where you can use the power of having a permanent insurance. Or let's say you have 100,000 of permanent insurance and $150,000 of term, so that you can use that 100,000 to grow, put that to work for you, and that way it's still rather cost effective, inexpensive, if you will, but you still getting it to work for you. So there's just a little different, a couple of different scenarios to look at to how much life insurance do you need, right? And why do we believe that every adult needs at least $250,000 of life insurance? Well, I've also talked about in the last video talked about the living benefits. Yes, the IUL has living benefits, but there are also term policies with the living benefits. Not all term policies are created equally. Okay, there are some that they don't have that. But when you're able to get a term policy with living benefits, although you're not able to take advantage of the cash value, you have those living benefits I talked about to protect against the threat of one, of course, the death benefit, that protects against the threat of death, but the threat of getting sick or getting injured. Okay, like I said, sometimes you can get injured and you lose the use of 2 out of 6 activities a day living. That could trigger a chronic, illness or injury, benefit, or if you have a long-term care rider on there. Okay, so those are a couple things. I hope that was helpful. Once again, make sure that you contact a financial professional to discuss these things, because tackling these things alone can be daunting sometimes and confusing. So you want to contact a financial professional so that they're able to help guide you through and help you and talk to them about these things that you've learned. Feel free once again to contact me either by email at loudslegacy22@gmail.com, or you can call my number 330-319-0141. That will be in the description. Hey family, remember to subscribe to the channel. If you like it, go ahead, like the video, press that thumbs up, share it so that more people can have access to this information. Leave a comment, and don't forget to hit that notification bell so that you'll be notified anytime I post a new video. All right, be blessed, family. I'm out.